So hedging is where you are looking to eliminate a risk or decrease a risk of a current position you have in the market or a future position that you know you're going to have in the market. So if just a general example is if you are an international company dealing in exports and imports, and you know that next month you have a very large invoice to pay. Let's say you're a UK-based company and you're buying goods from the United States. So you know in a month's time you need to exchange pounds into US dollars. Now, what can happen in between now and a month's time in the sterling US dollar rate? Anything could happen. It could get a lot worse for you. If the pound gets weaker, it means that this invoice you have to pay is going to become more expensive. So there are ways of hedging or negating that risk, reducing that risk in currency movements. And it can also be used if you've got a position on in the market as well. So if I hold a position to speculate in euro dollar, let's say I've got 100,000 long in euro dollar and I want to hold this because I'm riding a trend that I see. But this Friday is NFP and there's going to be a lot of volatility and I'm worried about my stop loss getting hit, whatever about the volatility there. So I could place a hedge so that over that period of time, I cannot lose any money from my position. So it's about placing another trade to hedge a current trade that you have open. So to hedge, you could just simply take the opposite position to the position that you're holding. If you've bought euro dollar, you could just sell the same amount of euro dollar and you would have negated the risk. But that doesn't necessarily make a lot of sense because you could just close the trade and then reopen it again when you felt you saw a more comfortable, a more comfortable price in the market, or that event has happened, and then get back in. But there is another way to hedge, and that's using options, which options traditionally were built as a hedging product, and that's because when you hedge with an option, your risk is negated, your risk is limited in the same way. But on the upside, if your position that you're holding can continue to make more money, then the option because the options loss is limited, it means that the position can make more money. The door is open for your whole position to continue making money. So it's a slightly, more dynamic, possibly a better hedge than just taking the opposite position.